Mic's on.
Hello everyone, my name is David McGregor. I'm one of the partners at Atlas Infrastructure, not to be confused with Atlas Arteria. And we are here today with Hugh Wehby, the CEO and MD of Atlas Arteria, Henry Byrne, CFO of Transurban, to talk about everyone's favourite infrastructure sector, toll roads, and transport in general. So maybe we can get into it. We've got 35 minutes. Actually, a little bit of housekeeping is we'll go through some questions. If anyone's got a burning question, feel free to stick your hands up and ask it, but I will leave some time for questions at the end. I think we've got some mic runners who can do that. So maybe we can jump in with a little bit of a, the current state of play. So maybe, Henry, I'll pass to you first. Maybe if you can just give us a little bit of an overview of, if you think about the last 5 or 6 years, we've come out of COVID, you've had a number of assets that have been in construction or been affected by construction. Can you give us a little bit of a view of where you're seeing traffic growth now and where you're seeing that going, maybe starting with the Australian market and we can move to the US after that?
Yeah, no problems. And I've probably spoken to a number of people in the room, so you will have heard me say this, but the way I characterise our portfolio at the moment is we're moving from a period of marginal headwinds to marginal tailwinds. And the reason I describe it like that is we have two ostensibly very well-performing networks in Brisbane here in Australia and then in North America in Washington. And then we've had our two larger networks in Sydney and Melbourne that have been a little more affected for different reasons, but have sort of been through a period where they've weathered some headwinds. Principally, when you look at the specifics in Sydney and Melbourne, you would say major construction projects, both our own and the government projects that have been going on for a number of years. And then we all know there are some dynamics that played out around Melbourne, particularly in those COVID and post-COVID years that were a little more acute than any of us were expecting if you went back 5 or 6 years. The good news is that we're coming out of that. So when we look at Melbourne, we've just opened up the largest sort of single addition to the road network there in nearly 2 decades in the Westgate Tunnel. And something like that, people here in Sydney will know, changes the dimensions of the network, changes the value proposition of the network, and provides a strong foundation, we think, to then feed the sort of top line growth for our network there. And we're starting to see that in the numbers. So the two sort of principal data points you'll need to look to are how does CityLink perform? And the numbers were pretty good at the half without being outstanding. But we did start to see all the dimensions of CityLink grow nicely. And then the other big question that we're working through with investors is how does Westgate Tunnel ramp? And many of us will have heard us say that we're pretty comfortable with where it currently sits, but that's a multi-year story in terms of how a major new piece of infrastructure grows into the kind of investment case that we've made there. So that's Melbourne, and then Sydney is a little simpler in that it's really just the unlock of the capacity that we brought online over a number of years. So we all know WestConnex is a huge addition to the network, and that is maturing well. It's still in that kind of multi-year ramp-up phase that I described Westgate's about to enter. And then we're starting to see the dissipation of construction impacts on a number of projects there. So this is the government's project around Warringah Freeway north of the Harbour Bridge here. I'm sure many of you have driven through it, but it's a huge sort of network, tangled sort of mess of emerging infrastructure that's yet to really deliver on the capacity. And then we've got our own project in the M7, M12 corridor, which is due to finish in the next couple of months. Those two projects alone, combined with the ramp on Westgate, give us a tailwind. So you then put all that together and you say Melbourne and Sydney moving from a period of sort of disruption impacted, construction affected traffic into a period of growth. And that's a multi-year story as we look out into 27, 28 and beyond. And then Brisbane and Washington, we think should continue to grow well. And so that presents a kind of nice portfolio picture in terms of how we see volumes.
Yeah. Just quickly on the hot lanes in, the high occupancy toll lanes in Virginia, you've obviously seen very strong revenue growth over the last couple of years. Has that just been sort of volume and congestion, or is that a sort of a step change in what you're seeing in terms of the way that you're pricing those assets?
It's a combination of the two. So anyone who looks at the numbers will unambiguously see that we have had fairly healthy price escalation on the network there. but we could only do that because of the strength of the underlying value proposition, and that value proposition's been strengthened significantly by investments we've made into the network. So we lengthened the 95 corridor with what's known as the Fredericksburg extension. We've added new kind of access points known as the Opitz Boulevard, which bring in new catchment zones. Just late last year, we completed the northern extension to the 495. All of that augments what was already, we think, a strong value proposition, and then unambiguously you can see the sort of price increases that are supported by that value increase. So we're, for those who know our numbers well, we're 20% compound annual growth over a couple of years there, and we still think there's some more sort of above trend growth to go.
Yeah, great. And then Hugh, maybe moving to Atlas Arteria's assets. Similarly, you've seen some good ramp up in traffic. How are you seeing that play through in the underlying assets, and then obviously coming through to the revenue line? How is that sort of playing through in the business at the moment?
Yeah, thanks. And it's a little bit simpler, albeit different between our different markets. So if I start with our biggest assets in France, very mature toll roads, very large network, 2,500 kilometres of roads. So we're seeing steady state growth, albeit with toll increases, supported by modest 1% to 2% growth across the network. Our newest road, the A79, France's first free flow toll road, is growing materially ahead of that. So it does go to some of the value propositions that you see when you upgrade infrastructure and move to free flow tolling, as opposed to what France has historically been used to. If we move across to the US, Dulles Greenway has been a fantastic story the last 3 years, almost 10% compound annual growth rate in both volume and revenue. Unfortunately, tolls haven't moved in those 3 years, and I'm sure we'll come back to that.
Yep.
But we are seeing the benefit of about 20 minutes peak time savings there now. For those of you who have followed that story, for many years the parallel roads were upgraded, the free roads by the state. Those upgrades have now finished, and we are getting significant time savings back on the tolled lanes, and so it's a great story and supports that overall thesis that Henry was talking about with the Virginia growth rate as well. And we're seeing that on Cintra's roads in the I-66 on top of both Transurban and Atlas's roads too. And then if I look at Chicago, always more of a revenue story. It's a very strong toll formula where you get the minimum of 2% CPI or GDP per capita growth. And coming out of COVID, we got extremely strong toll growth as opposed to volume growth. The elasticity is about 0.41. So we do tend to see a small reduction in traffic, but a material increase in revenue where we have those large toll increases. This year has been an incredibly challenging year operationally in the US with the winter storms. And so that's going to be very short-term impacts, but really challenging winter for those of you who have followed the conditions over there, particularly in Chicago. So the team's done well to get through that.
Yeah. No, great. And you pre-answered one of my other questions around the elasticity. A little bit of a bonus question here, and I think I've probably asked you this before in some of our meetings. Do you see an elasticity curve? And what I mean by that is, as you get tariff growth well above inflation, as many of your roads, or some of your roads have, do you get to the point where it just gets too high that the elasticity starts to sort of kick up?
Just one of our roads has that.
Well, sorry, just one, but hopefully a couple in the future.
Look, we haven't seen it to date, and we saw really material growth coming out of, as I said, in those tolls coming out of COVID, where during COVID you had the floor of the 2%, and then post-COVID you got the GDP per capita growth as it recovered. We saw very consistent elasticity behaviour. We're not flippant about that. We consistently monitor consumer experience, government response, licence to operate indicators, and we are really focused on our service levels there because we were conscious that with the tolls going up, our product was not improving to match that. So we have brought in an engineering CEO now that's really focused on pavement and tolling experience upgrades. So a little bit to what Henry was saying, you want to make sure that the experience keeps up with the tolls, but to date we haven't seen evidence of a curve as you rightly put it.
Yeah, and Henry, you haven't seen that yet in the hot lanes in terms of when you've been raising prices. You haven't been seeing it as a really, I mean, it's obviously you're meant to sort of push traffic off the road in a sense, but you're not seeing that step up dramatically in terms of affordability.
Not at all, no. And I agree with everything Hugh just said, and particularly the piece around ensuring that the value proposition, both perceived and actual, so we do a lot of work to make sure it's transparent because it's not always as transparent as you would like, but that is an essential underpinning to then the broader rules of thumb that we put out there around elasticities of demand. But I mean, it is proven with decades of data over various models that we have very, very low elasticities of demand.
Yeah. So it's a little bit of a segue to next sort of topic, a little bit more strategic, which is thinking about the current climate we have. We've got Trump in the White House, who hasn't been afraid to basically take back assets or stop assets in some different sectors, even infrastructure. So populist governments, affordability is a key concern, particularly with the rise of AI, power prices, obviously now conflict in the Middle East adding to that. So maybe, again, Henry, I'll start with you. But can you talk a little bit about the way that relationship or sort of working with governments has changed, and maybe where you're looking at that now? Maybe if you want to talk about New South Wales toll reform, and we can look about, we can talk about the US as well.
Yeah, I mean, Hugh and I have been talking about this for 10 years.
Yeah.
It's maybe the broader point is it's never a static proposition in terms of social license risk and broader sort of societal expectations, particularly in regulated industries, and particularly where private capital is partnering with the public sector in order to deliver vital infrastructure. So it's by no means a new thing, but the kind of the themes that we're grappling with now that have accentuated or emerged are no doubt, a rise of a sort of geopolitical environment that is much more fraught than it was previously, which is then giving governments pause to perhaps adjust posture in certain ways. And the only counter you ever have to that in a regulated industry is back to the point Hugh and I both just made, which is to ensure that you have a value proposition that is perceived and actual by not just the road users but by the government, and then how you go about delivering on that is also a relatively dynamic proposition. So what Transurban was doing even 5 years ago to deliver on that proposition is different to what we're doing today, and we continue, as a business, if I talk a little bit more specifically, we continue to push the evolution of our customer offerings in terms of what we're doing by way of customer interfaces, not just to remove friction in terms of how they interact with us, but also improve the ways in which they can discern the value that we're offering them. And then we're obviously striving to partner with governments to make sure that we can work with them to help meet their needs as well. And New South Wales toll reform is a perfect example of that. So it was I think everyone here is reasonably familiar with what it is. There was a kind of electoral policy position that was taken to the polls by the current government around targeting cost of living, which had tolls front and centre in that. And they instituted a review into tolling in Sydney. You would say initially that was an existential threat to a business like ours. And then you fast forward 2 years later and you see that we've been able to have a very sensible conversation with them. Very early on, they were able to allay the fears of capital markets by talking about the fact that they would honour contracts, by talking about the fact that we would strive to achieve value neutral and revenue neutral outcomes. Importantly, revenue neutral being that they wouldn't impact the investment proposition, particularly around the core distribution and yield of our business, but that they would keep us whole on that. And they did that because they saw a counterparty that was willing to work with them to help them meet their objectives, which is exactly what we've done. It's been a difficult and complex conversation that's not quite finished, but for anyone who listened to our earnings call, you'd have heard we're close. And so what that tells you is that there is a way through for corporates that are willing to engage in quite a nuanced way with government partners and do it in a way that pays homage to the fact that you have to have value at the centre of the discussion. But I think everyone here will then see the New South Wales toll reform outcome as something that probably reaffirms the model doesn't threaten it.
Very good. And then Hugh, maybe moving to some of your assets, maybe we can talk about France first. You've obviously had a couple of taxes come down, which has sort of hindered dividend growth a little bit in the short term. And then obviously the rebid of those concessions coming up over the next 5 to 10 years, yourself and the other assets, and then maybe moving to the DG and
Sure.
talking about the process going on there.
Yeah, absolutely. So for those of you who have followed our French concessions even semi-closely, know about the two reasonably recent taxes that have come in. Firstly, the TILD, which is the Long Distance Infrastructure Asset Tax, which was introduced 3 years ago. which has hit us by about 4 cents per annum in terms of our distributable cash flow. That is subject at the moment to 7 contractual litigations by the 7 contracts that are operated by the major operators. We're 2 of those. So that is a tax that came in that's specific to our industry that we think is not consistent with the contractual framework that we operate under, and through normal processes like we have historically, we're following a litigation pathway, as are Vinci and Abertis. And so that's the current status there, but that is intended by the government to be a permanent tax. The other one, the temporary supplemental tax, the TST, came in 2025 for a year and has been extended for 1 year. Disappointing, but it is an economy-wide tax, albeit only on companies with revenue over 1.5 billion euros per annum. Again, this is intended as temporary. There are precedents for temporary taxes in France, and we have been able to manage through that with our cash reserves in APRR network. What people do sometimes forget, and it's important, albeit doesn't offset all the pain that the new taxes have caused, is the corporate tax rate was reduced from 33% to 25% about 8 years ago, which we had to pay no compensation back to the state.
Yes.
So in a sense, there have been positive and negative movements. The 2 big ones, I don't want to sugarcoat it recently, have certainly been negative. The point you raised, though, is really important. This isn't just about our existing concessions. We have 5 concessions in France, 2 of which expire in 2035 and 6. It's about the renewal of those major concessions across all the big operators. They're likely to commence in the back end of this decade. And the tax environment, the regulatory environment, the contractual protections, the sovereign risk will be absolute key inputs into that tendering. And the message that the industry is sending the government by contesting these taxes contractually is the stability and certainty around the contracts is really important. It's not an angry debate. It's a process that we're following at the moment, and we are hoping that it is resolved in advance of the first of those tenders coming to market, which is likely to be SANEF, which is the first expiry in 2031, which is operated by Abertis. So lots to do there. We're taking a balanced approach, mixing government engagement, preparation for bids, but importantly, seeking to enforce what we believe are our contractual rights. If we move across the Atlantic, we talk about US and sovereign risk, but in the US, having operated with Transurban and now with Atlas, it really is state by state. So there are federal impacts, but what you are dealing with from a regulatory and often from a tax perspective are very state specific. What we deal with in Chicago, as an example, is very different to Dulles. And so in Dulles, our key regulatory challenge has been the need to seek annual price rise requests with the State Corporation Commission, our regulator. We have, for a long period, failed to achieve price rises, and we've taken a very different approach in the last year. And it's not all about collaboration. There's been some sticks and some carrots, if we're really honest. So there's kind of 4 big levers we're pulling. We've put in a new rate case, which is a request for increase, but that has come off the back of almost a year of working group engagement with the regulator and the counties. So trying to get closer to those that make the decisions and those that have been naysayers of the historic decisions. Secondly, we've sought legislative change, which allows us to go to 2-year rate cases and to get statutory response timelines from the regulator. Pleasingly, that's gone through the House committees, the Senate committees, and is subject only to a Senate vote now. So this week we'll work out whether we've been successful there, but it would just be a little positive step forward in our relationship and our ability to lock in rates in a more certain and long-term environment. The third is, and where I talked about not so collaborative, is litigation. So we had state and federal litigation. State is finished. We are taking federal action against the constitutionality of the law changes in 2021 that essentially imposed new restrictions and new timelines on our regulatory environment. That's currently in court, so very hard to comment on, but it isn't stopping us from engaging with the regulator and with Virginia to try and find shorter term solutions. That's where we're at the moment. Once we do get out of cash flow lockup, which we've been in for a couple of decades, it's actually performing really well on an underlying basis. Yeah. And so we need it to become a positive contributor to our portfolio, and that's what this is all about. And the state is partially on that journey with us, and we're hoping to bring us on the journey.
Do you think, actually, a bit of a bonus question here, talking about the cash lockup, for Route 7 and 28, the alternative sort of triangle,
yep.
What sort of growth do you think you'd need on the network to get Dulles out of lockup? Because obviously you guys would be taking a lot of the growth right now with 7 and 28, particularly through the peaks. Yep. Do you have a number in mind? Or, I mean, it's a bit of a hard question.
It's maybe hard only because I don't want to share the specifics.
I mean, that's what I mean in this forum. You can just tell me later.
Look, the simple answer is we're single-digit millions away from breaking even on cash flow. Yeah. Right? So we're not miles away, and we're growing still. We've grown the last 2 years about 10% traffic growth. Yeah. So we are getting very significant growth in the underlying asset without toll increases, and so we're not miles away. Yeah. What we need is a consistent, transparent, and reliable regulatory environment, which we don't have. So that goes to much more of the value play as opposed to the short-term cash and yield play. Yeah. And to optimise that value and to actually capitalise on what we think is a great asset and a great location in amongst a great network, we need that certainty.
Yep. No, very good. Last question, and then I'm happy to turn to the floor. I've got a couple of additions if there's no other questions, but one I did want to cover, and we've sort of talked about it a little bit, but particularly for toll road concession companies, you obviously have finite concessions, and so reinvestment is always a core focus for investors, unlike some of your other sort of infrastructure assets that are more perpetuity. So maybe if we think about Transurban and Atlas Arteria as capital allocators, which is what you are, can you give us a little bit of an idea about organic opportunities, inorganic opportunities, and sort of where you're seeing the guardrails in terms of protecting investor outcomes long term? Maybe Henry, I can start with you, if you want to cover that, and then we can come back to Hugh.
Yeah, sure.
Simpler for you.
Well, maybe not. I mean, the premise underlying the question is still sound. So these businesses ostensibly look like they're finite life businesses, except they're not. The history of Transurban and Atlas Arteria and others is that there is a opportunity to repeat deploy capital to lengthen them in ways that are done, that are mutually beneficial for governments, and they end up behaving more like perpetual life businesses. And we still see Transurban as fitting that model. Having said that, we are in a slightly different position to, say, a business like Atlas, in terms of where our weighted average concession length currently sits, and then how that drives the imperative of the conversation inside the business. So 28 years weighted average concession life means that this is not an urgent conversation inside Transurban. This is a measured and considered conversation around where best we think we can allocate capital to sensibly lengthen the portfolio. And then you look at what we're specifically working on currently. So, the model around augmenting the existing network footprints is alive and well, and there's a number of opportunities that we're in direct negotiation currently with governments on. So the ones we've spoken about are the Logan enhancement in Brisbane, the bidirectional enhancement in Washington. They're $1.5 billion, $2+ billion on those two alone. Before you think about M7, M2, we've started to talk in broad terms with the market about as a potential opportunity here in Sydney. And then there are opportunities that sit out beyond those around the existing network footprints, like large brownfield opportunities in Victoria. The North East Link is the one that everyone is looking at and expects to be brought to market at some point in the next 3 to 5 years. In Washington, we have the 495 Southern Extension, and then we have more opportunities in the Maryland precinct that we think will emerge over time as well. So that's existing network footprints continuing to throw up consistent capital deployment opportunities that are attractive and sensible for a business like ours, that augment the boundaries of the concessions at the margins. We're starting to look at new markets as well, and we have Atlanta and Nashville as the two that everyone's aware we're bidding alongside Ferrovial on currently in a competitive process. We'll see where that gets to. We're right in the middle of that process at present, but they look like interesting markets, large projects, deploying that kind of model around the express lanes that's proven to be attractive to governments, attractive to road users, attractive to concessionaire holders. So again, interesting opportunities that are yet to fully crystallise for us, but we're certainly there and actively working on them. So you look at that broader sort of proposition around repeat deployment of capital to augment the boundaries of the business, to continue to lengthen the kind of nature of what finite is, and that's alive and well for Transurban. And then the kind of broader piece that we're thinking about is how concessions evolve. So, how do we think about different pools of value? How do we think about leveraging our customer base into this for value? How do we think about the interplay with governments looking slightly different over time as well? And they're all conversations that we're having internally and then framing into how we then build up proposals that we will then play into those broader development discussions that we have.
Great. And then maybe Hugh,
Sure.
same thing. So I mean, you've talked about, I think since you've started in the role, you've had a bit more of a push towards, or moving towards growth. So maybe you want to talk about the way you're positioning that and what that might look like for investors.
Yeah, sure. And I think Henry used the term measured. I think I'd say measured and a higher level of urgency at Atlas for obvious reasons. So we have, as I mentioned, the two largest of our concessions in France expiring in 2035 and 36. In advance of that, we will commence material amortisation of the debt of those businesses, and therefore our distribution comes under pressure. So we've been really open in talking about, yes, we have a 40-cent distribution and we can maintain it for some time, but as and when that material amortisation commences, that starts to come under pressure. So what are we looking at in terms of growth? Well, three simple buckets, won't surprise anyone, and they will have heard me speak about it and maybe even seen an article in the AFR about it last week. But the first bucket is really organic cash flow growth, and that comes from really two places: underlying traffic performance, but the release of the cash from Dulles Greenway and having it as a contributing part of our portfolio, so those regulatory efforts in particular around that optimisation. The second, similar to what Henry was talking about, is expansion within our current footprint. So we've already got a number of additions to our French network. We have an option over the A412, which is under construction, and we have opportunities in other markets to look at ongoing expansion alongside partners. And so that's really utilising the existing portfolio to continue to get new concessions or to enhance the footprint or the longevity of the concessions. The third, which has been the newest of the buckets, is inorganic growth. And that's within some pretty tight parameters. We don't have the flexibility of balance sheet that Transurban and the like have. So we've been very clear that when we look at inorganic growth opportunities, we're in the brownfield space because it needs to be cash yielding. We'll only be looking at yield accretive projects. We'll only be looking at ones that have sensible valuations and that ensure we maintain a global and balanced portfolio. In terms of the opportunity set, that makes that very narrow. And we're very conscious of that and we don't hide from that. What it also means is that we're unlikely to use any material amount of equity given we're yielding over 8% at the moment. So we will need to look at capital sources as well as opportunity sets to make sure they match up. We are focused on working with partners, and we have spent some money in this area, as people know, in the last 12 months. Every opportunity we have considered, and in many cases rejected, some are ongoing, has been alongside partners. And so that's a really important part of our business. We know we don't have the opportunity to win every concession worldwide on our own. So picking the right partner in the right jurisdiction with the right balance sheet and the right governance model is really important for us. So this is not asset or opportunity specific. It's an ongoing effort for us. We'll continue to spend a small amount of money each year to try and progress it, but there is an imperative for us to look at replacement of those expiring cash flows in advance of when the French concessions get retendered. And clearly that is a huge priority. We've just got a couple of years to wait until those processes kick off.
No, great. Very helpful. Now we've got a bit over 5 minutes left. Are there any questions from the crowd? Anyone wants to throw a curveball? Otherwise, I can come back. No? Let's go to, so one question I did want to ask, particularly on that reinvestment piece, a lot of the greenfield developments we're seeing at the moment are the express lanes in the US. It's been, 15, 20 years since we've seen a good sort of washout of traffic forecasts, etc. We've seen a number of express lanes in the US get built over the past 5 or 10 years that when they were initially auctioned looked very punchy in terms of the revenue requirements, but have since come through and actually met their hurdles, or at least in the early stages. Maybe Henry, one for you, but you can both answer. Are there any sort of waypoints or flags you'd be looking at in terms of, as you go into that, for what can be very highly variable revenue, long-term revenue lines, what you're looking for in terms of making sure you're not overshooting too hard? I don't know if does that make sense, that
Yeah, no,
question?
it makes sense. I mean, it's the analysis we always go through when we're deploying billions of dollars of capital into new projects. The difference here, because the reference is really towards these new express lanes in Georgia, in Tennessee, and then there's North Carolina in play as well, albeit we're not there. They're highly contested scenarios, or there are 4 large consortia that are all marshalled around these, which in of itself reflects the fact that there is a clear alignment around the fact that there is a very interesting opportunity here, and that the model that is being bid around express lanes into markets with the right political dynamics, the right demographic characteristics, suggests that if you can bid these at the right value, there is a significant amount of value that will be there to be had. But again, it's a competitive scenario. So one of the assessments we will be making is where value sits, and then we will obviously not step beyond that. And if we lose on that basis, we're always happy to lose, and we've always said that. I've lived through points in the cycle where there have been a lot of competitive scenarios where capital has been torched, and we have absolutely zero interest in getting involved in that. So we will do our clear kind of robust valuation metrics with our partners, and then we'll work out where that can lead us to in terms of what we will bid in value, and we'll be comfortable winning at that level or losing at that level. There's a little bit of sort of extraneous stuff that you have to go through nowadays around analysis of geopolitical risks and the geopolitical environment, albeit the work we've done to date suggests that there's nothing that would prevent us from bidding currently, but we are probably doing more work than I have typically seen us have to do in that kind of domain in order to get comfortable with the kind of capital deployment we're talking about here. But ultimately then, if you read a headline that Transurban has been successful alongside its partner, well, you'll know that we saw value, and if we've lost, you'll know that someone else saw more value than we saw. Yeah.
It's deep.
Do you want to opine on that at all? Or?
No, I think Henry just eloquently covered it all.
No, that's great. Any other questions? Rob. A curly one coming.
So just as a hint, if you are asking a question, please identify yourselves. I'm Rob Coe from Morgan Stanley. I was going to ask you a question about tax, but I'm not going to do that. No. Can I ask just your longer term perspectives on technological change, autonomous driving, road trains for trucks, drone taxis, AI within your businesses, just some longer term strategic stuff that we don't often get to talk about, please.
I'll start briefly. I think within our network, the biggest opportunity comes with the refresh of the concessions in France. So the government has published some preliminary information about how they will retender and select concessionaires, and some of it is about the investment framework. Some really simple modernisations, so well short of what you're talking about, free flow tolling, number one. But when you talk about electrification and decarbonisation, they're both selection criteria for what they will look at for concessionaires of the future. So the investment you'll see around the network is going to be substantial in terms of ripping out old infrastructure, and as you do maintenance, it will require completely different products and inputs into the physical infrastructure itself. In terms of AI, we have it marginally, nowhere near where Transurban uses it, but for really tolling plazas in various of our toll roads. None of ours at the moment are particularly capacity constrained, but I think the trends you talk about vehicle-wise are really exciting from a road capacity perspective. That's where I see it making the most difference. So if we look particularly in Skyway in the very long term, the heavy vehicle capacity will be really important because the alternative routes are already constrained, and when you get to automation, that could be a very exciting capacity expansion without material investment.
Yeah, well, maybe I'll stay on that theme. So rather than talk about AI within our business, which is a big focus for the leadership group, that's probably going to take more than 50 seconds. But building on Hugh's comments there, because again, I agree wholeheartedly with them. The house view we've always presented on autonomous vehicles is fewer vehicles, more trips. So in a volumetric sense, they're a net positive for companies like ours. Now that's an hypothesis that will be tested in time, and whether we're right or wrong, that's our current view. I was over in the US with the board having a look at these projects we're bidding on earlier in the year, and we had the benefit of jumping in the Waymos there and just accessing that as you would just a consumer walking out of a hotel, and it was quite revealing and a little striking for us just in terms of how the technology's actually arrived. So as someone who has spoken a lot about this in forums like this over the past 5 years, I was actually a little bit shocked in terms of how real the value is and how accessible it is. And I think that one thing that we will all be testing urgently as we look out over the next few years is whether our timelines around adoption are correct, because there's a very strong value proposition that's very easily accessible in markets that have embraced this. So that's probably throwing out a sort of question back at the audience rather than answering anything.
Right as time's up. Great. Everybody, thank you. Let's thank Hugh and Henry.
Thanks, Dave.
Thanks, guys.
Appreciate it.
Okay, we got our allocations panel.